Hello everybody, welcome back to another valuation investing video. And today in this video, I'm going to be getting into Deckers Brands because Deckers Brands just reported their earnings and they're down over 10% right now. And year to date, the stock has been doing much worse. So we're going to be getting into Deckers Brands and to see whether or not this crash in the stock price is warranted and if we should be buying with this discounted stock price. So with that being said, let's get into Deckers earnings. But first, taking a look at the stock price, as I said, the stock's down 13% today, and taking a look year to date, the stock is down over 56%. This stock has been severely underperforming the market, and it's very similar. This is a very similar company to me, pretty much to Lululemon, I believe, but I think honestly Deckers might be a better growing company, but it's very similar in terms of the stock chart and also their fundamentals going forward. So with that being said, let's go over to the earnings report. And taking a look at Deckers Brands here, I just want to show you guys their main brands, and if you didn't know what Deckers Brands does, basically, it's just a more footwear and apparel company, pretty similar to Nike, just on a lower scale and not as many well-known say apparel, but it's still pretty known. I'm sure most people know what Hoka is and also UGG. And then they also have Teva, which may not be as known, and also Sanuk. But the main products here is Hoka and UGG. So these are the main products that they're selling. And taking a look at the earnings report here, they actually had a pretty good quarter. And taking a look at the earnings report here, they actually had a pretty darn good quarter here. As we can see, the EPS came in at $1.82 versus $1.58 expected. So they had a very good beat here by 15% on the EPS. And also here, taking a look at the revenue, they also did beat the revenue, not by a whole lot, by 10 million. But it's still a decent beat and did beat estimates. Also, looking at their other brands, like I said, Hoka, which is their second largest brand, reported 634.1 million, which did beat analyst expectations. Also, UGG really outperformed analyst expectations, reporting $759.6 million in revenue versus 740. So both of the two main brands coming out of Deckers Brands is really helping prop up these fundamentals, which could show signs of potentially weakness in the other areas. So that's something to consider. But at least the main revenue segments are doing good because that's the most important. But the reason the stock is doing so bad here is the full year guidance versus what analysts expected here. As we can see, they now expect approximately $5.35 billion in the full year 2026. Analysts expected about 5.46, so that is a miss compared to what analysts expected for the full year. And also the EPS is basically in line at $6.30 to $6.39. So overall, the guidance is not great. So that's why the stock is down about 10%. Do I think the stock should be down this much? Potentially not. Might be a little bit of an overreaction here, but it still definitely isn't great guidance. And taking a look at the key points that was made during this earnings call, we have the strong performance drivers was international here. International growth grew 29.3% year over year. So this really helped the growth rate of Deckers. This very reminds me of Lululemon, which internationally, Lululemon is what's carrying the business as a whole. And also it kind of appears that is what's happening with Deckers. But I do think that America growth is still positive for Deckers compared to Lululemon. It's decreasing almost. So at least Deckers looks a little bit more strong. But the main place for these companies to be growing is going to be internationally. And that's where they're going to find their next second wave of growth in the company. Also, the wholesale channel leads growth. The wholesale channel increased by 13.4%, so that's a very good increase, but the direct-to-consumer actually declined 0.8%, so that could be a little bit bad for the direct-to-consumer, but the wholesale channel is doing well in terms of basically selling it to all the retailers. Say you have Foot Locker or something like that. That's where the wholesale channel is, but the direct-to-consumer just basically buying from their website is doing pretty bad. So that is interesting because direct-to-consumer should have a higher profit margin, so you'd honestly rather see this increasing faster, but it's still not terrible, especially with the wholesale channel still growing at 13%. Also, brand specific dynamics, like we said, Hoka and UGG is really doing good and really did a very strong earnings, which helped this company really grow faster. Taking a look at other key areas of concern, though, is the slow domestic and direct-to-consumer sales. Domestic sales dipped 1.7%. Like I said, this is very similar to Lululemon, where the domestic sales are severely struggling, but the international sales are making up for it. Also, the direct-to-consumer decline, that's obviously not good. Also, there's some tariff headwinds. Wouldn't be too concerned about that tariff headwind. While it is definitely concerning, if we're taking a look at more the long term of the company, tariffs won't be a huge issue in the upcoming, say, 5 to 10 years, most likely. So it's definitely a concern, but if you're trying to look at the long term of Deckers, it's not too much of a concern. Also, deceleration in full year guidance, like they said, they just cut some of their guidance. And capital allocation is one good thing. They're repurchasing the 2.6 million shares for $282 million, and they're really buying back a lot of shares as the stock tanks. So at least that shows confidence in the management about this company as the stock continues to fall. Now, taking a look at the SWOT analysis here on market-io, if you want to go check it out, 7-day free trial, link in the description. And looking at the SWOT analysis, showing us the strengths, weaknesses, opportunities, and threats here. The strengths are strong financial performance. It's growing pretty fast still. The company's still growing pretty well. Also, the premium brand portfolio of UGG and Hoka really started to dominate and started to be trending more towards these brands, which I think is definitely a strength. However, clothing is more trends, and if that trend starts to go away, then we're going to see a very severe punishment with that. And that's why I don't love investing in clothing or fashion brands or anything that's really trending, where it's not really a huge moat compared to other companies like this. So that's a slight concern to me. Also, this company is pretty profitable in their industry. 25% net margins, very high. Direct-to-consumer dominance, 45% of revenue comes from direct-to-consumer channels. Like we said, the direct-to-consumer is very good for also increasing those margins. That's why this company, Deckers, has a high margin, because a good amount of their sales do come from direct-to-consumer, which will automatically increase the margins. But like I said in this recent earnings, that direct-to-consumer actually decreased, and that is slightly a red flag for me. If anything, I would rather see the wholesale revenue decline and the direct-to-consumer increase, but that is not what's happening. So now, taking a look at the weaknesses, we have margin compression risk for this company. Also, we have growth sustainability concerns. Most people are probably expecting this company to decelerate in growth. Also, operational challenges, regulatory and tariff pressures, and also consumer and economic sensitivity. So with that being said, let's go over to my valuation investing website over here and take a look at Deckers, the full fundamentals. Let's go in depth into the fundamentals, and then let's also use my intrinsic value calculator to get a fair value price and to see what price I'd be willing to pay for this company. So looking at Deckers here, the company's trading at a $13.29 billion market cap. So this company's not that big, especially compared to some of their competitors like Nike, Under Armour, Adidas, even Lululemon. Not really Lululemon, but I do like to compare those companies because Lululemon is more definitely clothing, while Deckers is more shoes. But these companies are very similar in terms of fundamentals and just how everything's playing out. So with that being said, the PE ratio very low at 13. That's showing us a very cheap price to pay for this company. So that's good, at least in terms of valuation. But taking a look at the balance sheet here, also net cash is over $1 billion. So that's very good. They can pay off all their debt right now if they wanted to. So that's very good in terms of the debt situation. Here, with the 7-step stock analysis, we get 6 out of the 7 key metrics. So this looks very good. The only thing that's bad is the debt to free cash flow here. So with the debt to free cash flow, that shouldn't be non-applicable. If anything, the reason it's because of this is their debt is so low. So don't worry about this X. Technically, they have 7 out of the 7 key metrics, because if they really want to, they could pay off their debt right now, just in an instance, with the amount of cash they have. So that's pretty good. And the growth rates also look very good at 16% revenue, 33% earnings per share growth, and they're buying back shares. This company looks very good. It's just the industry it's in, I just don't love this industry of clothing and apparel because it's trendy industries and it's not really recurring revenue. You can't really get recurring revenue as well in these industries. So that's the only reason I'm hesitant on these type of companies like Lululemon or Nike or even this company Deckers. It's a little bit of a harder investment to get into just because of that. So with the revenue growth here, let's do the bear case. Let's do 4%. We're going to be pretty conservative here because I do expect them to decelerate growth. I'm going to do 4, 7, and then let's do 10%. I think they're going to grow at mid to high single digits in the next 5 years. And I'm going to be conservative because I do truly think that these companies are going to struggle in the future because once you get to a certain place, it's hard to keep growing. And the only thing that's looking good for this company to keep growing is internationally. So that's the only way I think they're actually going to grow in the future. For the future profit margin, I expect them to potentially decrease their profit margin, honestly. Bear case, I'm going to do 18. Right now, the profit margin is at 19.36. I'm going to put base case, let's do 20. Bullish case, 22. I expect it to be around the same. So with that being said, I do think that the direct-to-consumer, that is slightly worrying. As I said, as it decreases, it's going to make this company have a less profit margin. Now for the future P/E ratio, with a 4% revenue growth, they deserve probably a 13 P/E ratio. Base case, I'm going to give this company a 17 P/E ratio. Bullish case, I'm going to do 21. Now, for the shares outstanding, they're buying back at about 2%. So I'm going to do bear case 2%, base case 2.5%, bullish case, let's do 3%. So calculating the intrinsic values here, we get an annual return base case 16.2%. So if you are willing to take the risk on this company in terms of lacking a good economic moat compared to other companies, and just the overall industry of clothing is very trendy. So if the trend goes away from this company, say, because I know Uggs have been trending over the past few years, if that goes away, this company is going to start to struggle even more. So you got to be willing to take the risk and say, is the risk to reward worth it? Me personally, right now, I don't think it is. Even though there's 16% annual return, I just think these companies are going to struggle in the future just because the domestic growth is negative, which is a pretty big red flag. And the only way they're going to continue to grow is internationally, and that's going to start to decelerate. So with that being said, thank you guys for watching this video on Deckers Brands. Please subscribe. Let's get the YouTube channel to 5,000 subscribers by the end of the year. Please like and comment. If you want to go check out this website I made, click right here. You can get a 7-day free trial on the Patreon, and then you can check out this website. Thank you guys for watching. See ya.